What happens if a buyer loses financing mid-contract? When a home goes under contract, most buyers and sellers assume the most difficult steps are behind them. The price is agreed upon, inspections are underway, and closing dates are penciled into calendars. Yet one issue can abruptly disrupt even the smoothest transaction: a buyer losing financing after a contract has already been signed. In today's market, where interest rates, insurance costs, and underwriting standards continue to evolve, financing fallout is more common than many realize. Understanding what happens next is essential for buyers trying to protect their deposit and for sellers weighing their options. Why buyers lose financing after going under contract. Mortgage approvals are not final until the loan closes. Even buyers who are pre-approved can face unexpected hurdles during underwriting. Common reasons financing falls apart include changes in employment, new debt taken on after contract acceptance, credit score fluctuations, or issues uncovered during appraisal. In Pinellas County, rising insurance premiums and property-specific requirements can also affect loan approval late in the process. If coverage costs exceed what was originally estimated, lenders may reevaluate debt-to-income ratios, sometimes leading to denial. The role of the financing contingency. Most residential contracts include a financing contingency that gives buyers a defined period to secure a loan. If financing is denied within that window and the buyer provides proper notice, the contract typically allows the buyer to exit without penalty. The key detail is timing. Once the financing contingency expires, protections may narrow significantly. Buyers who lose financing after this deadline risk forfeiting their earnest money unless other contingencies apply. What sellers can and cannot do. When a buyer's financing falls through, sellers are not automatically required to release the buyer from the contract. The seller's rights depend on contract language, deadlines, and whether contingencies were properly exercised. Sellers may have several options. Agree to release the buyer and return the deposit. Negotiate an extension if the buyer can secure alternative financing. Retain the earnest money if the buyer is in default. Relist the property while pursuing damages, though this is less common. In competitive Pinellas County neighborhoods, sellers often prioritize minimizing downtime and may choose the fastest path back to market rather than extended disputes. Earnest money and financial risk. Earnest money is designed to protect the seller if a buyer fails to perform. If financing collapses outside the contingency period, disputes over deposits can arise. Escrow agents typically hold funds until both parties agree on release or a legal determination is made. This is one reason buyers are advised to avoid major financial changes during escrow. Even a new car loan or job change can have consequences that extend beyond loan denial. How transactions recover after financing fails. While losing financing can feel final, some deals are salvaged. Buyers may pivot to a different loan program, bring in a co-borrower, or renegotiate terms if the seller is motivated. Sellers, meanwhile, often move quickly to secure backup offers or relaunch marketing to avoid extended market time. Local data shows that well-priced homes in Pinellas County frequently regain buyer interest quickly, even after a failed contract, though momentum can vary by neighborhood and season. Why this matters in today's market. With affordability under pressure and lending standards closely scrutinized, financing stability has become a central risk factor in residential transactions. Buyers must understand that approval is conditional until closing, and sellers must evaluate offers not only on price, but on financial strength. The transactions that hold together are often those where expectations are realistic, timelines are respected, and both sides understand the limits of contractual protection. Key takeaways. Losing financing mid-contract is disruptive, but not uncommon. Outcomes depend heavily on contract terms, contingency deadlines, and communication. For buyers, financial discipline during escrow is critical. For sellers, flexibility balanced with clear enforcement of contract rights can reduce losses and delays. In an environment shaped by shifting rates and rising ownership costs, informed preparation remains the best safeguard on both sides of the transaction.